So take us through the key expectations, how the stocks are positioned ahead of the numbers. Apurva Prasad, research analyst at HDFC Securities, is with us. Apurva, morning, and thanks for joining in. We all know, and we've been talking about it, and you flagged it, that Q1 is going to be weak, and there is a very high likelihood that Q2 is also going to be a subdued quarter. So is it not priced into the stocks right now? Do you think there's really a risk of an earnings downgrade and the actual numbers could negatively surprise?
So good morning and thanks for having me on your show, Reema. So yes, we have seen valuations correct fair bit from the highs. In fact, even on a YTD basis, we've seen over 5 to 7% correction in the valuations, despite the dichotomy that continues to play out in the sector between the tier ones and mid-tier. So having said that, Q1 we expect to be weak because let's not forget Q1 is historically been a very strong quarter for the sector. So, with that context, we do expect a very flattish performance in Q1. And we do expect lower than historical average in Q2 is what we've built in. And a recovery only coming into the H2 of FY24. So that's the trajectory that we've built in. We do believe that, the sector growth, which decelerates from 13% the previous year to mid-single digit, that can go back to high single digit, the following year. But yeah, 2-3 points. One is while the aggregate growth for the sector slows down, the growth dispersion between companies would increase. So I think that's one thing. Second, the problems continue in the near term. So most of the lead indicators that we look at, or the experts that we speak to, we understand that some of the supply side indicators have remained where they are the last 2 months or so. So none of that is indicating revival in the near term. However, if one is to look, more from a tactical standpoint, and the valuation point that you were referring to, Reema, if you look at the divergence between an Accenture valuations and the IT index, I think that's pretty much widened over the last couple of months. So yeah, so that being a case in point, valuations are today a lot closer to the historical long-term averages. Some companies even below that. And those could provide more attractive price points.
Can you tell us the valuations of the stocks as they stand today versus the long-term averages? You said some of them are below their long-term averages. Which one and by how much?
Yeah, so if you look at stocks, so Infosys, for example, if you see versus where they have been long-term and versus where they are post the correction in Q4, they're certainly there. If you see Tech Mahindra, again, closer to Wipro, would be closer to long-term averages. But, our preference is really for companies where the visibility of growth is higher. So the ones that we do like within that, it would be an LTIMindtree, which wouldn't also be too far from its own relative long-term, so to speak. So I think the range would probably be minus 2-3% to plus 8% as compared to long-term average. That's where they're trending. It's a lot different within the mid-tier IT space.
Okay. Hi, Apurva. Morning, and thanks for joining us. For HCL Tech, in specific, we have seen that stock, very weak ahead of its numbers, of course. And I know this time around the revenue growth is pretty much flat. Can you tell us, how much of this do you think is baked into the price? And also, how soon do you think we can maybe see a pickup in this?
So HCL Tech more recently has outperformed. If you see some of the factors around capital allocation, and payouts that has this improved for the company. So these were historical concerns, and as a result, we've seen the discount to larger peers has gone up, has reduced, in more recent times. So what we're building in within the tier 1 IT, we still think HCL Tech would be the strongest, although it's flattish, but 1% Q1Q is what we are building in for HCL Tech with a marginal dip in margins. From a full year standpoint, we do think that the 7.5% midpoint in their services revenue that can stay intact, even as Infosys may cut the higher band of its guidance for FY24. So, but we do expect for HCL Tech 2 to 3% growth premium versus larger peers for FY24.
HCL Tech to beat the larger peers' growth rates by 2 to 3%. That point is taken. Let's get to TCS in particular. What will positively surprise the street and what will negatively surprise the street on revenues in constant currency and on margins? And what's the deal win number that you're looking at?
Sure. So, I mean, on the numbers, so deal win numbers, you're looking at in excess of 10 billion plus. So, of course, Nest, BSNL would be contributing significantly there. So, negatively surprised if outside those two large deals, if the bookings are lower, because that remains a strong indicator for future growth. We are building in slightly lower than I believe where consensus is. So, we are about at 0% Q1Q constant currency. Margins, although we don't expect to decline as much as what the street expects. I think street is expecting 110 basis points. We're about 80 to 90 basis points sequential decline. So I think the historical impact of wage increase for TCS would be lower this time around, and there would be some offset. So yeah, so negative surprise would come in if the deal TCV number is up 10. That would be one. And of course, the outlook with the new leadership change would remain the key point to look at.
What will the TCS management say when they talk about the demand environment? Will they continue, will they in any way indicate that a recovery in H2 is on the cards? And if they don't say that, do you think the street will be very disappointed?
So, Reema, I think it's going to be more vertical specific because of the relative higher exposure in some of those verticals. So I think it's going to be more pertinent how some of those verticals are playing out across geographies. So, for example, if continental Europe continues to remain strong, and I think the last couple of quarters we've seen incremental optimism in that geo commentary from the management. So how does that stand? Continental Europe also relative to US has been doing relatively better. So I think some of those core geo trends as well as core vertical trends, and one would have to do slicing and dicing there to get a more clearer view. I'm not quite sure if an H2 acceleration, the company does not have a formal guidance, but yeah, the near-term trajectory is something which one would be more keen to look at, especially post Accenture numbers, I think, with the kind of commentary that they had.
Apurva, we lean to you to get more clarity on what the managements have to tell us in the post Q1 earnings call. Thank you very much for joining in, and remember, you can